Canaccord Genuity Chief Market Strategist Tony Dwyer joins us now for more on the markets. I should say rates and earnings, both playing a factor on the equity markets. Speaking of the equity markets, you had a note out on the 22nd, I believe, which predicted the bounce that we've seen largely over the last few days. As you look back, do you think that the recent downturn was largely due to technical factors or fundamental factors? And what does that say about the upturn that we are currently experiencing?
Well, good morning. You had been up so far so fast, and optimism had become extreme. Basically, everybody that wanted to buy had bought, and that showed up in all the data that we had. It was a record run of, we look at a weekly stochastic, just using some technical stuff, even though I'm a macro guy. Our weekly stochastic on the S&P was above 90 for, I think, 19 straight weeks. That just doesn't happen. It's historically pretty unique. So when you get that kind of run, you're due for a pullback, and higher rates have given us that opportunity for a pullback. Honestly, it looks a lot like it did last August. You're in a bull market. You had a heck of a run. You got overly optimistic across the board, and you're getting a pullback based on rates.
So what does that tell you about kind of what to expect in the future? Are you encouraged by what you've seen from earnings so far?
Earnings are pretty good, but again, so it's very interesting. When you look at last year and even the first quarter of this year, if you exclude the Magnificent Seven from the S&P operating profits, you have that's 100% of the earnings growth. You would have negative earnings. Also, if you go into the end of this year, that's going to change, where you're going to have a much better distribution of earnings. So the real bull story for the broadening out of the market comes down to two things. You have to have lower rates. That's what drove the recovery that we had off of last October's October 27th low. It was lower rates and hopes for a broader distribution of earnings, not just being concentrated on the Mag 7. So those two things actually come into play. So our game plan coming into this year was to have some corrective action based upon just a historic run we've had. And we're in the process of that. And I think once you work your way through that, it's going to set up for a real good ending to the year.
Hey, Tony, a lot of the doves are leaning on a lot of leading indicators, NFIB hiring intentions, or this PMI services employment index, or median price in existing homes suggesting disinflation in the back half. You still buy that?
Yeah, Carl, it's very interesting. Any survey-based thing like the NFIB Hiring Plans Index hit a cycle low in its most recent reading. All the ISM employment indices are right bouncing along the cycle low. We'll get a better reading next week. Ultimately, I can't find where the employment is happening when you look at any of the small business hiring plans or any of the manufacturing sector. So where is the employment data really booming to the point that it's keeping monetary policy high? And I think that's where, as we work through the middle of the year, we do actually get some weakening in the employment data. That gives the Fed plenty of room after a historic run higher in rates to actually cut rates. Carl, just like 7 rate cuts at the end of December was excessive, only 1 rate cut may be as well. The market has gotten it wrong over the course of the last 2 years of how many remember, going into 2022, there were only going to be 3 rate hikes, meaning 75 basis points was predicted to be the high of the cycle. So I think we just have to continue to look for what can turn the tide in its earnings and distribution and its lower rates.
The Goldilocks of rates, 7 too high, 3 or 0 to 1, maybe too low, and we'll see 2 to 3 seems like consensus right now. Thank you, Tony.
My pleasure. Have a great day, guys.